So, good afternoon, everyone. Welcome to our discussion for today. My name is April Joyce G. Ocampo, and today we're going to discuss with you our second topic, which is transfer pricing. So, we have seven contents of this topic, which is number one, transfer pricing definition. Second is the need for transfer price. Alternative transfer pricing schemes. Fourth is distress prices. Fifth is transfer price for services. Six is multinational transfer pricing. And seven is illustrative problems. So before we proceed with the number one subtopic of transfer pricing, let's learn first how does transfer pricing problem arise. So the rationale of transfer pricing comes up from a problem that is common to most companies operating with decentralized segments is that of placing a fair value of exchange of goods and services between segments within the company. This challenges of placing a fair value of exchange of goods and services between segments is the problem of transfer pricing. So when goods or services are transferred from one unit of an organization to another, the transaction is recorded in the accounting records. In the days when all companies were small and management was centralized, accountants transferred goods and services from one cost center to another at the cost of production. So before, when small business are centralized or have centralized kind of management, the decision making when it comes to transfer pricing by the accountants is very easy to manage because centralized have simple divisions. But because nowadays, um, many companies are giant conglomerates, meaning they are very big companies, and those big companies always have multiple divisions. So simply transferring goods and services at cost have no longer serves the needs of these decentralized organizations. So the problems arise in transfer pricing um, revolve around the question of what transfer price to charge between segments. So paano ba mag-charge ng price kapag nagkakaroon ng transfer pricing? So let's move on to our first topic now that we understand the problem of transfer pricing, which is transfer price definition or overview. So as you can see, transfer price is the price charged when one segment of a company provides goods or services to another segment of the company. So for example, when the bakery of Ruston Incorporated transfers bread to the supermarket divisions, some transfer price must be agreed upon. So in here, um, when the business bakery of Ruston Incorporated transfer bread to the supermarket divisions, of course, the price will be changed. But how are they going to charge that good to be able to give to the company or the supermarket divisions? Paano? So yon, they have to use transfer price. So yung price na binigay nila sa company, yun yung tinatawag na transfer price. Pero yun na nga, how are they going to deal with this type of um, pricing? Paano sila mag-charge? So, kailangan nating intindihin what does transfer price do sa company natin. Why do we need to understand transfer price? So first of all, the need for transfer price is because sa iba, the transfer price of interdivisional sales will affect the selling division sales and the buying division cost. But although will not have direct effect on the company's profit, however, the transfer price policy of the company can have indirect effect on company's profit by influencing decisions of the division manager. So in here, sabi dito, yung pagbigay ng transfer price sa company o sa segment company, merong effect sa division sales or the selling division sales and buying division cost. But although wala namang effect sa company's profit, ang magkakaroon lang ng effect sa company's profit is yung decision ng division manager. So sabi nga, sa decentralized organization, kanya-kanya silang power and authority and functions. Pero meron silang kakayahan magkaroon ng um, decision or pwede silang mag-influence dun sa decision ng division manager. So in here, kung walang maayos na transfer price policy ang isang company, this will affect the company's profit sa pagbigay ng transfer price. So another reason bakit kailangan natin intindihin yung transfer price is because to some of the departments selling goods and services, the transfer price is its of revenue. And to the department buying the good and services, the transfer price is its cost. So dito na pag-usapan natin na sa department na nagbebenta ng goods and services, kailangan the policy of transfer price is tama because revenue nila yun. They will get their revenue from putting the right charge sa goods or services na meron sila. At the same time, sa department na naman na nagbabay ng mga goods and services, although this is not a revenue, this is a cost for them. Mas kakaroon sila ng mas maayos na decision kung yung transfer price ba nila is tama naman or yung in-agree nila na mag-agree ba sila dun sa binigay na transfer price ng department. Kung wala kang masyadong understanding when it comes to transfer price, pwede kang maloko when it comes to buying the goods and services. Okay, but the most complex one, why does the problem of transfer pricing is needed for us to understand, is because transfer pricing itself is complex. Transfer pricing becomes complex because of the need to evaluate an organization segments. So yun, dahil companies have a decentralized type of organization, nagiging complex yung transfer pricing, especially if merong division manager na hindi align dun sa goal ng company. So maaring mamali sila dun sa ah, mamali sila dun sa pag-follow ng transfer pricing ng company. At kung wala naman, maaring magkaiba-iba sila. So, it is important na magkaroon tayo ng maayos na understanding sa transfer pricing policy. So, yun na nga, if there is complexity or difficulty when it comes to transfer pricing sa isang kumpanya, the suggested solution is to establish a transfer pricing policy that encourages decentralized managers to make an economically optimal decision for the company without significantly reducing their autonomy. So, yun, they need to have a transfer pricing policy. Hindi lang basta transfer pricing policy. It is said that it should encourage managers to make an economically optimal decision. And this way, it can help the company to gain more profit and magkaroon din ng smooth company performance. So, now that we're done with the definition of the transfer pricing, let's move forward to the alternative transfer pricing schemes.
Good day everyone, I'm Janelle Villacruz and I'll be discussing the minimum transfer price. So when a business transmits its product among business units, they must set a pricing structure so that each unit can measure its own profitability. In fact, companies use innumerable approaches to determine the minimum transfer price. However, the most used economic transfer pricing is differential cost per unit plus loss contribution margin per unit or outside sales or opportunity cost per unit. Differential cost is also known as variable cost that includes raw materials, piece rate labor, production supplies, delivery costs, and packaging supplies, adding the contribution margin per unit that is lost to the selling division as a result of giving up outside sales. This contribution margin depicts the amount of money that is available to pay the fixed costs such as rent and utilities that must be paid even when the production is zero. Meanwhile, opportunity costs represent alternative activity over another as it offers a higher return in value or benefit. To set an example, LR Company has two divisions, L1 and L2. L1 can produce up to 2,000 units of products per year. All 2,000 units can be sold at a market price of 88 pesos. What is the minimum transfer price that would be acceptable for L1? As given example, 37 pesos is our variable cost, and to work out our opportunity cost, in this case, we're gonna take 88 pesos, which is the market price, minus our variable cost, then we will have an opportunity cost of 51 pesos. And therefore, the minimum transfer price is 88 pesos, which is the market price as well. If we wish to sell the product externally, we would be paying its variable selling cost, let's say 5 pesos. Using the same scenario, once again, our variable manufacturing cost is 37 pesos. And instead of 51 pesos as opportunity cost, we would less the 5 pesos, which will result in 46 pesos. So, our minimum transfer price in this instance is actually 83 pesos. Since variable selling cost is considered as variable expenditure, it is meant to be deducted to arrive at a contribution margin. However, if we wish to transfer it internally, we no longer have to pay that outside selling cost of 5 pesos. Transfer price can be more than the amount shown by the formula, But for internal transfer, the transfer should not exceed the purchase price from the outside supplier. If the selling division has sufficient idle capacity to meet the demand of another division without cutting into the sales of its regular customers, then it does not have any opportunity cost. Generally, transfer pricing rules aim to set standards for divisions in order to enhance overall business profit. The transfer price should be established at the differential cost to the selling division, usually variable cost plus the opportunity cost if executing the deal internally. None if the seller has passive capacity, or selling price minus differential cost if the seller is at capacity. Let's say L1 and L2, the two divisions under the LR company. Formerly, all transfers of products from L1 to L2 were valued at the variable cost of 6 pesos each. However, the L1 division would like to raise the price to 9 pesos per unit between the two transfer prices, which should be used for their company's profit maximization. This actually depends on whether the L1 division is below capacity or at capacity. Assuming that the L1 division is below capacity, then this would mean that there is no opportunity cost of selling internally since no outside sales are relinquished. Therefore, L1 division should set the transfer price at its variable cost of 6 pesos per unit to ensure L2 division does not purchase the products from another supplier. If L1 sets the transfer price higher than 6 pesos per unit, there will be a risk that L2 will find another company willing to provide the products for an amount less than 9 pesos and higher than 6 pesos. Now, if the L1 division is at capacity, it will create an opportunity cost of selling internally. Given these new circumstances for LR company, the L1 division should set the transfer price at its variable cost of 6 pesos per unit plus the opportunity cost of selling internally. Assuming that L1 division sells the product to outside consumers for 10 pesos each, the opportunity cost of selling internally is 4 pesos, which makes 10 pesos as market price minus 4 pesos as variable cost. Taking everything into account, the amount that one unit of a firm owes another unit of the company for an item or service is referred to as a transfer price. A company can compute the lowest allowable transfer price as the variable cost plus an estimated opportunity cost.
Good afternoon everyone, I'm Rafael Francisco and ako po yung next na reporter. And my topic is about market-based transfer price. Under this approach, the transfer price is the price at which the goods are sold on the open market. It is perhaps the easiest form of transfer pricing when it comes to determining the price that will be paid between divisions of the same companies. The market price approach is designed for situations in which there is an outside market for the transferred product or service. The product or service is sold in its present form to outside customers. And it is a simple supply chains where goods are passed from one division to another, and it worked well for the companies without a lot of subsidiaries. If the selling division has no idle capacity or spare capacity, the market price in the outside market is the perfect choice for the transfer price. The reason for this is that if the selling division can sell a transferred item on the outside market instead, then the real cost of the transfer as far as the company is concerned is the opportunity cost of the lost revenue in the outside sale. And whether the item or yung product is being transferred internally or sold on outside of the market, the product costs are exactly the same or pareha lang po siya. If the market price is used as the transfer price, the selling division manager will not lose anything by making the transfer, and the buying division manager will get the correct signal about how it really cost the company for the transfer to take place. Yung market-based transfer price is considered as the best transfer price because it dovetails well with the profit center concept and makes profit-based performance evaluations feasible at many levels of the organization. And maraming tao ang naniniwala that market-based transfer pricing, which bases the prices of the items or the goods of what you'd find in the open market, is the best pricing type of method. And by using market prices to control the transfers, all the divisions or segments are able to show profits for their efforts, not just the final division in the chain of the transfers, where it uses the normal market rate that would be paid if the goods were bought on the open market. This means that both subsidiaries end up doing just as well as they would if they were selling or buying goods from the third party. Itong market price approach na ito ay sobrang nakakatulong particularly sa mga highly decentralized organizations. As a general rule, this policy should contain the following guidelines. First, the buying division must purchase internally so long as the selling division meets all bona fide or yung mga genuine and real outside prices and wants to sell internally. Second, yung selling division ay malaya to reject ng mga internal businesses kung yung mga internal businesses na yun ay mas nagpe-prefer to sell outside. Then third, if the selling division does not meet all bona fide or yung mga genuine outside prices, then yung buying division ay malaya din to purchase outside. And fourth, an independent and impartial body must be established to settle disagreements between divisions over transfer prices. Ang market-based transfer price approach ay may main advantage na sa pagiging objective dito at when it comes po sa measuring, ito'y unbiased. Although they might fluctuate, di maiiwasan yung act of irregular shifting because of the market conditions na pabago-bago rin over time. Further, this approach is difficult to manipulate.
Good day everyone, I'm Joanna May M. Huria and I will discuss the cost-based transfer price. Cost-based transfer pricing is a method of setting prices when selling products to division within the same company. It is used to reduce a tax payment. For example, if a company owns and operates a factory in a country with a low tax rate but sells its product in a country with a higher tax rate, it pays fewer taxes by setting a high transfer price. When external markets do not exist or not available to the company, or when information about external market prices is not readily available, companies may decide to use form of cost-based transfer pricing system. Cost-based transfer prices may be in different forms such as variable cost, actual full cost plus profit margin, standard full cost, and to calculate this formula, cost-based transfer price is equal to variable cost plus fixed cost. Another cost-based transfer price is variable cost transfer price. Variable cost-based transfer pricing is useful when the selling division is operating below capacity. The manager of the selling division will generally not like this transfer price because it yields no profit to that division. In this pricing system, only variable product costs are transferred. These costs are direct materials, direct labor, and variable factory overhead. variable cost has a major advantage of encouraging maximum profits for the entire firm by passing only variable cost alone to the next division. Production and pricing decisions are based on the cost-volume-profit relationship for the whole firm. And among disadvantages of using variable cost or differential cost basis setting transfer are: number one, a company must cover all costs before earning a profit. Number two, it allows one segment manager to make a profit at the expenses of another segment manager because the receiving segment receives all the profit. Number three, the use of this method could lead to dysfunctional if a segment must forego outside sales to make products for other internal segments. And lastly, transfer prices based on differential cost diminish and autonomy in decision making of the profit center. Next is full cost transfer price. It is often used by firms as it very difficult to calculate the precise demand for a product and establish a market price. The empirical studies indicate that full cost pricing methods are widely employed by business firms. The overhead costs are generally calculated assuming less than full capacity operation of a plant in order to allow for fluctuating levels of production and costs. Many companies use full cost because of the following reasons. Number one, it is easy and very convenient. Number two, it leaves no intracompany profit in inventory to eliminate when preparing consolidated statement. Number three, it allows simple and adequate end product costing for profit analysis by product lines. Is goal congruence. The use of full cost transfer price can lead to a decision that are not goal congruent when the supplying division is not operating at capacity. It is a situation in which people in multiple levels of an organization share the same goal. A well thought out organizational design causes goal congruence and result in an organization being able to work together to accomplish a strategy. Next is standard full cost. In actual cost approaches, there is a problem of measuring cost. Actual cost does not provide any incentive to the selling division to control the cost. All product costs are transferred to the buying division. While transferring actual cost, any variances or inefficiencies in selling divisions are passed along to the buying division. The problem of isolating the variances that have been transferred to subsequent buyer division becomes extremely complex. To promote responsibility in the selling division and to isolate variances within divisions, standard costs are usually used as a basis for transfer pricing in the cost-based system. Whether transferring at differential cost or full cost, standard cost, where available, are often used as a basis for the transfer. This encourages efficiency in the selling division because inefficiencies are not passed on to the buying division. Otherwise, the selling division can transfer the cost inefficiencies to the buying division. Use of the standard cost reduces the risk to the buyer. The buyer knows that standard cost will be transferred and avoid being charged with supplier cost overruns.
Good day everyone, my name is Eliza M. Bautista and I will be discussing alternative cost measures. Alternative cost measures have two types, which is full absorption cost-based transfer price and cost plus transfer. Let's talk first about the meaning and the disadvantage and advantages of full absorption cost-based transfer price. Full absorption cost is a managerial accounting method for capturing all costs associated with manufacturing a particular product. The term absorption costing means that the company's product absorbs all the company's costs and entails allocating fixed overhead costs to all units produced for an accounting period. It captures all of manufacturing cost of production, such as direct materials, direct labors, rent, and insurance. Some advantages of this approach are: first, costs are available in the company's records. Number two, they provide the selling division with a contribution equal to the excess of full absorption cost over variable cost, which gives the selling division an incentive to transfer internally. This may be a better measure for the differential cost of the transferring internally than the variable cost because other costs, such as unknown, engineering, and design costs, are included. And lastly, it implies with GAAP and more accurately tracks profit than variable costing. It takes into account of production costs unlike variable costing which only consider variable cost. And for the disadvantages, a full absorption cost-based transfer price or skewed profit loss, which means it can cause a company's profit level to appear better than it actually is during a given accounting period. This is all because all fixed costs are not deducted from revenues unless all of the company's manufactured products are sold. In addition to skewing a product and loss statement, this can potentially mislead both company's management and investors. Second is no influence on operational efficiency because it fails to provide as good an analysis of cost and volume as variable costing. If fixed costs are a substantial part of total production cost, it is difficult to determine variable in cost that occur in different production levels. These make it more difficult for management to make the better decision for operational efficiency. The second type of alternative cost measure is cost plus transfer. So first, what is cost plus transfer? Cost plus transfer is a traditional transaction method, which means it is based on markups observed in third-party transactions. It is mostly applied to the routine manufacturing and of tangible goods and to services provided by one companies to other related companies. Cost plus transfer looks at comparable transaction and profits of similar third-party organizations to ensure companies are fairly allocating their international profit. Some of the advantages of cost plus transfer are: cost plus pricing strategy takes few resources. It doesn't require a lot of additional market research, and business are mostly aware of the cost product production by adding up different invoices, labor costs, and etc. Businesses can then take the sum cost and place a margin on top of them that they believe that the market will bear. It's pretty simple, and for this reason, it's a popular strategy among small businesses and businesses where other aspects of production must take precedent. Second is cost plus pricing model provides full cost coverage and consistent rate of returns. As long as whoever is calculating the cost per user or item is adding everything up correctly, cost plus pricing ensures that the full cost of creating the product or fulfilling the service is covered, allowing the markup to ensure a product positive rate of return. Yet, many additional costs often can be accounted for, which result in reduced margin. And lastly, some of the disadvantage of cost plus pricing is: first, cost plus pricing strategy can be horribly inefficient. Why? Because the guarantee of a target rate of return creates little incentive for cutting cost of or increasing profitability through price differentiation. As the market and customers continue to change, stakeholders easily become passive towards pricing, facilitating laziness and atrophy of profits. Just for some perspective, the government uses this strategy for guaranteed profit margins on cost to make contracts with private businesses easier. The result is an incentive to maximize costs, which wastes billions of dollars and result in shoddy workmanship. And lastly is cost plus pricing method creates a culture of profit-losing isolationism. This inwards-facing approach discourages market research. Although watching competitors' prices isn't the end all, it is pretty important because of pricing. You should be aware of how much the competing goods cost because it can affect your marketing and pricing strategies. Plus, with no research, you have little to no data on your customers' perceived value of the product, or more in the last point. And that will be all. Thank you for listening. And again, I'm Eliza Bautista.
Good day everyone, I'm Rochelle Phoenix and I will discuss to you the negotiated transfer price. Under this system, managers are permitted to negotiate the price for internally transferred goods and services. Managers act much the same as the managers of independent companies, and they use negotiation strategies similar to those employed when trading with outside markets. So what does the negotiated price means? It is an attempt to simulate an arm's length transaction between supplying and buying segment. If companies give segment managers autonomous authority to buy and sell as they think necessary, and if they bargain in good faith, the result of this bargaining is the equivalent of a market price. The major advantage of negotiated transfer prices is that they preserve the autonomy of the division manager. However, negotiation may be very time consuming and require frequent re-examination and revision of prices. Furthermore, negotiated prices eliminate the objectivity necessary to ensure maximization of company-wide profits. As a result, the negotiated price may distort segment financial statement and mislead top management in its attempt to evaluate performance and make decisions. Performance measure may depend more on the manager's ability to negotiate than on other factors.
Good day, everyone. My name is Abigail Sardo, and my discussion is all about distress pricing. So, what is distress pricing? A distress pricing refers to the price at which a company marks down a product or services instead of discontinuing it. It is the minimum price at which a company can sell an item and make profit. So meaning, yung distress pricing is when a corporation or a company reduce the price of a certain product or services rather than terminating or removing it. So instead, they set the price to its lowest possible price at which a company may still sell an item without compromising its profit. When supply outstrips demand, market prices may drop well below their historical average. If the drop in prices is expected to be temporary, these low market prices are sometimes called distress prices. So yung market prices daw, if it may continue to fall drastically below its historical average, kung saan yung supply is nag-exceed sa demand, the low market prices are which referred to as the distress prices if only the price collapses is anticipated to be just temporary. So the question is, if distress prices prevail, which transfer price should be used to evaluate a company performance? It's either the distress price itself or the long run average prices or normal market prices. In the short term, the distress price itself is used. The selling division's manager should pay the distress price if it surpasses the incremental cost of supplying the product or services. Otherwise, the selling division should stop selling the product or services to the buying division. So instead, they should purchase it from a third-party supplier. This method would boost the overall operational income for the company. On the other hand, if the long-run average market price is utilized, requiring the manager to buy internally at a higher price than the current market price will affect the buying division's short-term performance and understate its profitability. However, using the long-run average market price, it gives a more accurate picture of the supplier's division long-term health. Nevertheless, if the price remains low over time, the corporation should use the distress price as the transfer price. The selling division's manager must then determine whether to sell some manufacturing facilities or shut them down and have the buying division buy the goods from an outside supplier.
So now I will be discussing again the topic transfer price for services. In here, we were going to answer how does um, we are going to charge the transfer price for services. So in many departments or departments of many large organizations may sell services for customers and for each other internally. The department performing the services to a second department generates revenues from such activity. The same transfer is the second department's purchase of services. For example, a company typically bill administrative services such as computer processing, accounting, payroll, and personnel to the departments they support. In each of the cases, equitable transfer prices must be established to appraise the department's performance for its own return on invested capital. So there are steps that can be followed in setting transfer price for services. First is to identify the different department contributing various services. Second is to evaluate the corresponding skills and experiences of personnel involved in delivering services. Third is to estimate the cost involved in providing the service. Factors such as time requirements, qualifications, cost of the facilities needed to provide the service should be considered. And lastly is to adopt one or any of the principles applied to the transfer of products in this chapter. So as you can see, in order for us to charge the transfer price for services, it's a little bit different from transfer price for goods. But in here, we can identify that or generalize that in order to set the transfer price for services, we need to understand it deeply or the services that we'll be going to offer. We need to know all the information, evaluates the skill and experience of those involved in the service, and of course apply the transfer principles na we learned earlier. So that's how we charge transfer price for services.
Hello everyone, I am Danica Bisinho, and the topic that I am going to discuss is about multinational transfer pricing. So, transfer pricing is a technique used by multinational corporations to shift profits out of the countries where they operate and into tax havens that involves a multinational selling of goods and services. But how transfer pricing works? So, transfer pricing is an accounting and taxation practice that allows for pricing transaction internally within the businesses and between subsidiaries that operates under the common control or ownership. The transfer pricing practice extends to cross-border transaction as well as domestic ones. A transfer price is used to determine the cost to charge another division, subsidiary, or holding company for services rendered. In other words, transfer prices are reflective of the going market price for that good and services and can also be applied to intellectual property such as research, patents, and royalties. In international transfer prices, it creates opportunities for multinational firms to shift profits between divisions located in high tax countries to those in low tax countries. In so doing, they seek to minimize tax payments and increase corporate profits and shareholder value. The prevalence of this practice has not been lost on tax authorities, as evidenced by the increasing number of countries enacting regulations to capture an appropriate share of corporate income. The transfer pricing strategies offer many advantages for a company from a taxation perspective. Although regulatory authorities often frown upon the manipulation of transfer prices to avoid taxes. Effective but legal transfer pricing takes advantage of different tax. Here is the example problem about transfer pricing of Lewis Company, where the marketing divisions decided to reduce the sale price of Lewis pants. The company's variable manufacturing and marketing costs are differential to this decision, but fixed manufacturing and marketing costs are not. The transfer price that correctly informs the marketing manager about the differential cost of manufacturing is 190 pesos. Production is operating below capacity, so there is no opportunity cost of transferring internally. If the production manager set the price at 380 pesos, the marketing manager would solve the minimum price shown in the solution. So, the marketing manager set the price in excess of 400 pesos per pair, where in fact, prices greater than 200 pesos would have generated a positive contribution margin from the production and sale of pants. For question A, if production is operating at full capacity, the minimum price is 400 pesos. And for question B, if the production division had been operating at capacity, there would have been an implicit opportunity cost of internal transfer. Production would have foregone a sale in the wholesale market to make the internal transfer. The implicit opportunity cost to the company is the lost contribution margin of 190 pesos from not selling in the wholesale market. But if the production had sufficient sale in the wholesale market, it would have to forego those sales to transfer internally. So the transfer price should have been 380 pesos.
Good day, everyone. I am Alfijoy and Samonte, and I am the next reporter of this group. So I will be discussing the illustrative problem 20.8. Assume the speakers division of Mega Audio Company supplies speakers to outside customers at a price of 350 pesos each. The company has just acquired a radio assembly company. The president believes this newly acquired radio division should purchase speakers from the company's own speakers division because this division has excess capacity. Until the acquisition, the radio assembly company had purchased transistors for 350 pesos less a 10% discount. Assume no additional machines or supervisors will be acquired for the internal transfers and the speakers division cost is direct material 100 pesos, direct labor 115 pesos, variable overhead 50 pesos, fixed overhead is 30 pesos, so the total cost will be 295 pesos. So here are the various members of management that have proposed the following transfer prices. Number 1 is differential cost. It is the differences between the cost of two alternative decisions or of a change in output levels. This is an appropriate transfer price for guiding top management in deciding whether there should be transfers between the two divisions as long as the total differential costs are less than the outside purchase price of the buying division. So the differential cost of this example is 265 pesos. This transfer price would be appropriate only when the selling division has excess capacity, just like in this example. Also, this would be appropriate in situations where there is no outside market. All benefits of using differential cost as the basis for transfer price accrue to the buying division. Number 2 is the full cost or total cost. So the total cost is 295 pesos. This transfer price would be appropriate if the company treats both divisions as cost centers rather than as independent autonomous profit centers. In this example, speakers division profits are reflected in the profits of the radio division when using this transfer price. Number 3 is the market price. Market price is the current price at which products, services can be sold or bought. This transfer price represents the price that the radio division pays an independent outside suppliers and is appropriate if the company treats both divisions as independent units. So unlike the full cost, market price pays an independent outside suppliers. So nakuha yung 315 because niless yung 10% discount sa 350. So number 4, full cost plus markup. This price is not appropriate because it exceeds the price that the radio division pays an outside supplier. In addition, the speaker division has excess capacity and its opportunity costs are zero because it lose no contribution margin if the internal transfer occurs. However, if the speaker division receives more outside orders than it can fill and has no capacity, so yung 85 pesos represents the speaker's division's opportunity cost. So naging 85 pesos siya kasi yung differential cost nila sa 350. Using the general formula of adding opportunity cost to differential cost results in 350 pesos. So kaya naging 350 pesos yung full price plus markup kasi nga tig-add yung opportunity cost sa differential cost. So 265 differential cost per unit plus 85 lost contribution margin on outside sales is equal to 350 pesos. Number 5 is the prime cost. This price would not be appropriate because it does not cover all the differential cost of the speaker division. So nakukuha yung prime cost sa kapag plinas natin yung direct materials and direct labor, kaya siya naging 215 pesos. And the last one is negotiated price. It is a price agreed upon for the supply of goods or services by both buyer and seller. A negotiated price of 290 pesos would be appropriate if the company treats both divisions as profit centers and both divisions share in the benefits. So, maano naman natin na yung both divisions nag-agree sa 290 pesos kaya ang negotiated price ay 290. As just illustrated, the transfer price selected should depend on the capacity level at which the selling division is operating, as well as on other factors unique to the situation.
Good day everyone, I'm Leralyn P. Bachiller and I'm going to discuss this illustrative problem 13.9. So first, this is the problem. NY Company's electrical division produces a high-quality transformer. Sales and cost data on the transformer follow. Selling price per unit on the outside market is 40 pesos. Variable cost per unit is 21 pesos. Fixed cost per unit based on capacity is 9 pesos. Capacity in units is 60,000. NY Company has a motor division that would like to begin purchasing this transformer from the electrical division. The motor division is usually purchasing 10,000 transformer each year from another company at a cost of 38 pesos per transformer. NY Company evaluates its division manager on the basis of divisional profits. The number 1 required is assume that the electrical division is now selling only 50,000 transformers each year to outside customers. The first problem is From the standpoint of the electrical division, what is the lowest acceptable transfer price for transformers sold to the motor division? This is the solution. The lowest acceptable transfer price from perspective of the selling division, the electrical division, is given by the following formula. Transfer price is greater than or equal to variable cost per unit plus total contribution margin on lost sales over number of units transferred. So this is the given data. Transfer price is greater than or equal to variable cost per unit, which is 21 pesos, plus total contribution margin on lost sales, which is 0. Since there is enough idle capacity to fill the entire order from the motor division, there are no lost outside sales. Over number of units transferred, which is 10,000, it is equal to 21 pesos. Since the variable cost per unit is 21 pesos, the lowest acceptable transfer price as far as the selling division is concerned is also 21 pesos. Number 2 problem. From the standpoint of the motor division, what is the highest acceptable transfer price from transformers acquired from the electrical division? Solution. The motor division can buy a similar transformer from outside supplier for 38 pesos. Therefore, the motor division would be unwilling to pay more than 38 pesos per transformer. So, transfer price is greater than or equal to cost of buying from outside supplier is equal to 38 pesos. Number 3 problem. If left free to negotiate without interference, would you expect the division managers to voluntarily agree to the transfer of 10,000 transformers from the electrical division to the motor division? Why or why not? Solution. Combining the requirements of both the selling division and the buying division, the acceptable range of transfer prices in this situation is 21 pesos is less than or equal to transfer price is less than or equal to 38 pesos. So, assuming that the managers understand their own businesses and that they are cooperative, they should be able to agree on a transfer prices within this range and the transfer should take place. Number 4 problem. From the standpoint of the entire company, should a transfer take place? Why or why not? Solution. From the standpoint of the entire company, the transfer should take place. The cost of the transformers transferred is only 21 pesos and the company saves the 38 pesos cost of the transformer purchased from the outside supplier. Number 2 required. Assume that the electrical division is now selling all of the transformers it can produce to outside customers. Number 1 problem. From the standpoint of the electrical division, what is the lowest acceptable transfer price from transformers sold to the motor division? Solution number 1. Each of the 10,000 units transferred to the motor division must displace a sale to an outsider at a price of 40 pesos. Therefore, the selling division would demand a transfer price at least of 40 pesos. This can also be computed using the formula for the lowest acceptable transfer price as follows. So this is the given formula and data. Transfer price is greater than or equal to 21 pesos plus 40 pesos minus 21 pesos times 10,000 over 10,000 equals to 21 pesos plus 40 pesos minus 21 pesos is equals to 40. So, kinancel na yung parehas 10,000 kaya naging 40 pesos tas minus 21 pesos na lang. Second problem. From the standpoint of the motor division, what is the highest acceptable transfer price for transformer acquired from the electrical division? Solution. As before, the motor division would be unwillingly to pay more than 38 pesos per transformer. Number 3 problem. If left free to negotiate without interference, would you expect the division managers to voluntarily agree to the transfer of 10,000 transformers from the electrical division to the motor division? Why or why not? Solution. So, since the requirements of the selling and buying division in this instance are incompatible, the selling division must have a price of at least 40 pesos, whereas the buying division will not pay more than 38 pesos, so that the agreement to transfer the transformers is extremely unlikely. Number 4 problem. From the standpoint of the entire company, should a transfer take place? Why or why not? Solution. From the standpoint of the entire company, the transfer should not take place. By transferring a transformer internally, the company gives up revenue of 40 pesos and saves from 38 pesos for a loss of 2 pesos.